In 1929, Joseph Kennedy executed a trio of moves months before the market imploded. He shifted into cash. He bought gold. He bet on volatility. When the market later plunged by nearly 90%, Kennedy walked away with tens of millions, while most people watched their life savings evaporate. Fast forward to 1987, Paul Tudor Jones made the identical set of moves: cash, gold, volatility. And when the market crashed on October 19th, suffering a single-day decline of more than 20%, Jones pocketed roughly $100 million in one day. In 2008, Michael Burry, John Paulson, and others followed the same roadmap: cash, gold, volatility. They turned crisis into billions. And now, in 2025, the world's biggest allocators, the likes of Warren Buffett, Ray Dalio, and others, are assembling the same three trades again. This is not coincidence. It is not a string of lucky guesses. It is a repeatable mechanical sequence because crashes themselves tend to unfold the same way: extreme valuations, excessive leverage, a triggering event, forced liquidation, panic. Investors who see the sequence early act in predictable ways, and the three trades consistently map to each phase of the collapse. My goal in this video is simple. I will explain exactly what each of the three trades is, show how they were executed in 1929, 1987, 2008, and now 2025, and why understanding the sequence gives you agency, a real choice about what to do with your money. Start with the first trade: convert to cash. The earliest sign of smart money positioning usually arrives about a year to a year and a half before the blowup. This is the recognition phase. Valuations have detached from reality. Risk now exceeds reward. Savvier investors start exiting their long positions to protect capital. In 1929, Joseph Kennedy had been one of the era's most aggressive speculators. He had built large positions across many stocks during the Roaring Decade. But as leverage climbed and enthusiasm reached fever pitch, he recognized the fatal flaw. When everyone is fully invested and highly leveraged, there are no marginal buyers to keep prices aloft. A small decline triggers margin calls, forced selling accelerates declines, a vicious feedback loop. So Kennedy gradually and discreetly moved a large portion of his holdings to cash over the summer of 1929. He avoided crashing the market by selling in stages, and by early September he was largely out of risk. 7 weeks later, prices began their catastrophic fall. In 1987, Paul Tudor Jones followed the same logic. He had been running a successful macro fund, and by mid-1987, concluded valuations were disconnected and structural risks, like program trading and frothy margin, made a crash likely. Jones reduced long exposure throughout August and September and raised cash while calmly briefing investors he expected trouble in October. When the market peaked in early October and then collapsed later that month, Jones was largely liquid and prepared. 2008 was more dispersed. Different investors reached the same conclusion at different moments. Michael Burry began converting to a defensive posture in 2005 after his work on subprime mortgages exposed systemic risk. John Paulson acted in 2006 as he built specialized bets against mortgage securities. Warren Buffett quietly amassed cash in the mid-2000s, signaling that he could not find attractive values. When the crisis accelerated through 2008, these investors were sheltered by their cash positions. Today, the cash conversion is obvious at scale. Corporate treasuries, legendary value managers, and insiders have been selling into strength. Berkshire Hathaway's cash pile has swelled into the hundreds of billions of dollars. Company executives, founders, and insiders across multiple sectors have been reducing holdings. These actions are not trivial. They are the people with privileged visibility into business fundamentals. Their behavior looks an awful lot like the same systematic exits that preceded prior crashes. Trade 2 is wealth preservation gold. Cash protects against forced liquidation, but it is exposed to inflation and currency debasement when central banks respond to systemic shocks. Gold has been the classic hedge for millennia. In 1929, investors who held physical gold or allocated to hard assets found protection when currencies and policy shifted in the early 1930s. In 1987, gold provided a safe harbor during the acute panic. In 2008, gold's role was pronounced D. As central banks flooded the system with liquidity, the metal surged and preserved purchasing power for those who had allocated to it. Today, central banks themselves are active gold buyers at a scale unseen in decades, accumulating thousands of tons across recent years. Sovereigns and large private allocators have been expanding gold allocations as a diversification away from a single reserve currency. Prominent investors publicly recommend holding a modest percentage of portfolios in gold as a hedge against systemic currency risk. That accumulation, central and private together, is the modern manifestation of Trade 2. Trade 3 is the profit trade volatility exposure. The first two trades protect capital and purchasing power. The third monetizes the collapse itself. Historically, this has taken the form of short positions, put options, or credit default swaps, instruments that pay off when markets or credit instruments fail. In 1929, shorting stocks was the mechanism. In 1987, exchange futures and put purchases offered a levered payout as the market plunged. In 2008, the innovation was credit default swaps on mortgage-backed securities. Investors paid insurance premia for years and then collected enormous life-changing payouts when defaults spiked. The modern equivalents are still the same idea: buys that explode when volatility spikes, institutional derivatives activity in index puts, VX options, and credit default swaps for stressed sectors like commercial real estate has been unusually elevated. That is the current evidence of Trade 3 being established. Combine all three trades, and you have a tactical blueprint cash to avoid forced liquidation, gold to guard purchasing power when policy turns expansionary, and volatility bets to convert crisis into outsized profits. Later, after the panic subsides, those who successfully executed the three moves deploy capital aggressively into high-quality assets at fire sale prices. That subsequent action, buying at maximum fear, is the implicit fourth move the very richest performers have executed to create multi-generational wealth. But none of that is possible without the discipline to make the first three moves first. Over the next sections, I will trace the detailed mechanics of each trade in every prior episode and explain how to implement simplified versions if you are an individual investor. I will also lay out a timeline based on observable indicators and finally give a practical checklist so you can decide calmly and rationally how to allocate today. To understand why the three trades work so consistently, you need to see the crash as a mechanical process rather than a random disaster. Every major collapse follows a recognizable life cycle. It starts with a bubble. Asset prices move far beyond what fundamentals justify. In the 1920s, stock prices had soared to multiple times earnings. In the 1980s, indices climbed rapidly while leverage through program trading amplified movements. In the 2000s, housing values rose on broadly weak underwriting and layered financial engineering. In 2025, valuation metrics across markets are extreme relative to output and productivity, a modern analog of prior excess. The bubble progresses into euphoria. Sentiment becomes unanimous, narratives replace analysis, and every marginal investor is convinced that prices will only go up. In past episodes, there were colorful signs. Office chatter about stock tips in 1929, faith in computerized strategies in 1987, the belief that housing could not fall nationally in 2008, and today's all-consuming narrative that artificial intelligence will transform every company overnight. Narratives make people irrationally confident. Next comes maximum leverage. Optimism begets borrowing. Investors and institutions lever up to amplify returns. In prior crashes, leverage took different forms: margin loans on equities, synthetic portfolio insurance, structured credit with hidden gross exposures. But the effect is the same: a fragile system where relatively small shocks can generate outsized losses. When losses occur, margin calls, covenant triggers, and funding stress force positions to be closed, and that leads to the next stage. A trigger event, it can be idiosyncratic or systemic, sets off the chain reaction. Often the trigger is inconsequential by itself. Its significance is that it reveals how vulnerable the system is. In the past, the trigger has been a singular scandal or an institutional failure, but the underlying fragility ensures the trigger becomes the mechanism of contagion. Forced liquidation follows. Levered holders are compelled to sell to meet margin calls and redemptions. Sales overwhelm liquidity, bids evaporate, and prices fall rapidly. What may have begun as a modest decline becomes a cascade because the system is mechanically designed to amplify selling. Finally, panic sets in. Correlations spike. Every asset trades like a risk asset, and liquidity dries up. When fear reaches its zenith, assets trade at prices divorced from long-run value. This is the terrain where our three trades operate. Cash means you are not on the wrong side of forced liquidation. You have optionality. Gold means you hold something that tends to retain purchasing power when currencies are debased by policy responses. Volatility bets are the mechanism to monetize the panic when prices implode. Together, they cover the life cycle of a crash and explain why these particular moves have been repeated by successful investors for nearly a century. Now let's return to historical specifics and the execution details investors used. Joseph Kennedy's cash conversion was strategic. He did not unload everything in one block because that would move the market and reduce his realized proceeds. He sold incrementally, quietly, and in ways that avoided signaling panic. That patience mattered. It meant he exited exposure with minimal slippage and preserved capital to buy the cheap assets that later appeared. He also supplemented the cash conversion with short positions, a classic way to profit from the coming decline. accepting persistent small costs in the interim in exchange for outsized payout when volatility arrives. Paul Tudor Jones offers a more modern template. Jones wrote down his analysis, explained the expected timeline to his investors, raised cash, and then bought protective derivatives that would spike if the market sold off. He accepted a series of negative carry payments for months as markets rose and doubts mounted among less patient investors. But when the event occurred, the payoff dwarfed those interim costs. Michael Burry and John Paulson illustrate a more complex derivative strategy. The instruments were not widely available initially. They had to be invented and negotiated with counterparties. Burry and Paulson secured credit default swaps as a way to synthetically short slices of the mortgage market. They paid insurance premiums for years. That persistence meant they had to keep investor faith through long drawdowns as housing prices rose and critics mocked their position. But once defaults accelerated, the asymmetric payout structure produced returns that dwarfed any conventional trade. That long pattern of paying premia to generate enormous asymmetric payoffs is the core of the volatility trade. You tolerate small, repeated losses, the insurance premium, for the chance of a catastrophic payoff when the market reprices risk. Modern instruments make the execution more accessible to large and small players alike. Index put option markets, VIX futures and options, and credit default swap markets for stressed sectors are where institutional players place their volatility bets today. An elevated put call skew, heavy put buying across expirations, and rising spreads for credit insurance on vulnerable asset classes are the fingerprints of professional hedging and speculation. If you are not an institution, you cannot buy bespoke credit default swaps in size cheaply, but you can emulate the mechanics. You can buy puts on broad index ETFs with expirations out several months to a year. You can allocate a small portion of your portfolio to physical gold or a gold ETF, and you can increase your cash position to reduce vulnerability to forced selling. The goal is to replicate the risk management architecture that the big players use, scaled to your means. There is a critical psychological element to all of this, making the three trades as stressful. You give up potential short-term gains, and you endure the social pressure of being wrong while the market keeps rising. But the discipline separates those who protect capital from the crowd. When fear reaches its maximum and asset prices are at multi-year lows, you must have the courage to deploy the preserved capital and realized profits into high-quality, undervalued companies and assets. That final act, buying where others are selling, is where generational wealth is created. Over the next chunk, I will turn very practical. I will outline implementation steps for individuals at 3 risk levels, offer concrete allocation examples using only widely available instruments, and provide a monitoring checklist of indicators that historically preceded major downturns. If you choose to act, you will need both a plan and the psychological preparation to execute it. Now we get practical. If you accept the thesis that crashes have a mechanical sequence and that the 3 trades consistently map to that sequence, how do you, as an individual investor, implement a scaled and realistic version without institutional access or enormous capital? Below are pragmatic, modular plans at 3 typical risk capacities: conservative, balanced, and aggressive, followed by a watch list of signals to monitor and a simple, disciplined execution checklist. Conservative plan: preservation first, a portfolio exposure to risk assets reduced to roughly 30 to 40%. Cash allocation: raise to roughly 30 to 40% and hold in short duration treasury bills or high quality money market funds for liquidity and capital preservation. A gold allocation: allocate roughly 5 to 10% to physical allocated gold or a high quality gold ETF that tracks bullion, not miners. Avoid leveraged or complex commodity products. A volatility hedge: purchase a small, recurring put protection program. For example, buy put options on a broad S&P ETF with expirations in 6 to 12 months and strike prices moderately below the market. Size: so premia equal 1 to 2% of portfolio value over the course of the year. Treat this as insurance you hope you never cash in. Why this works: you minimize forced selling risk, preserve spending power if policy debasement occurs, and have limited, affordable insurance that will spike in a severe downturn. Balanced plan: protection plus optionality. A risk assets maintain roughly 40 to 50% equity exposure focused on quality and cash flow resiliency. E-cash: hold 20 to 30% in short-term treasury bills or high-grade corporate paper. A gold 5 to 10% in bullion or ETF. A volatility hedge: allocate a slightly larger recurring budget to put options or buy a ladder of puts across expirations to smooth premium consumption. Consider acquiring a small allocation to long VX products or structured notes for diversification of protection. Why this works: you keep participation in upside while preserving optionality to buy aggressively if panic offers bargains. Aggressive plan: levered optionalities for experienced investors only. Risk assets retain 50 to 60% exposure, but focus on high-quality companies with strong balance sheets. Cash maintain 15 to 20% for deployment. The gold 5 to 10%. The volatility allocate a more material portion, perhaps up to 5%, to long-dated put options, VIX long positions, or derivative wrappers that provide leveraged upside during crisis. This is speculative and requires strict position sizing. Why this works: you aim for outsized gains from volatility bets while remaining able to deploy material capital at the bottom. Now the watch list, indicators that historically preceded crashes and which the smart money tends to respond to in time. Extreme valuation metrics relative to historical norms, multiples of earnings, price to GDP measures, and market capitalization to national output ratios. A margin debt at or above prior cycle peaks. The insider selling that is materially above historical norms, particularly among executives and founders. The surges in central bank gold purchases and sovereign diversification away from a single reserve currency. The rising prices for credit default swaps in vulnerable sectors such as commercial real estate or leveraged corporate borrowers. Elevated put call skews, concentrated institutional put purchases, and rising open interest in long, dated put series. The stress in short, dated funding markets, widening interbank spreads, and signs of liquidity drying up. Macroeconomic imbalances, unsustainable fiscal deficits, rapid debt accumulation, and the like, that will be exposed when growth slows. Execution checklist. Disciplined actions you can follow now. 1. Determine your risk tolerance and select the corresponding implementation plan. 2. Gradually scale your cash position over weeks to months to avoid market timing risk and to minimize slippage. Sell into strength, avoid panic selling. 3. Acquire gold as a slow accumulation program to avoid paying a premium in a single purchase. Use allocated storage or a physically backed ETF. 4. Implement a put ladder. Stagger expirations and strike prices so you are not dependent on a single timing window. Keep premium consumption modest relative to portfolio size. 5. Prepare a buy list of high-quality companies and assets you would purchase at various drawdown levels. Rank them and decide allocations in advance. 6. Set emotional guardrails. Rehearse behavior for scenarios of large drawdowns, practice executing limit orders, and commit to a plan to buy into panics. 7. Monitor the watchlist signals weekly and maintain situational awareness. Adjust hedges and cash as evidence accumulates. A few important caveats. First, none of this is guaranteed. Markets can remain irrational longer than anyone expects. Insurance premium will be lost if the crash does not arrive in your time window. Second, this is not personalized financial advice. It is pattern recognition and operational guidance. If you have complex needs, speak with a licensed advisor. Third, execution matters. Poor timing, highly concentrated bets, excessive use of leverage, or reliance on illiquid instruments can destroy capital despite correct thematic views. Finally, the greatest edge is psychological discipline. Protecting capital is boring. Buying insurance is emotionally costly while markets continue to rise. But the investors who made fortunes from prior crises endured derision, short-term underperformance, and stress. They accepted negative carry, paid premia, and sat through seasons of doubt. When panic arrived, they had capital, courage, and a plan to buy at the trough. That combination, preparedness and conviction under pressure, is the true differentiator. Here is the bottom line: history offers a reliable pattern. Convert to cash, preserve purchasing power with hard assets, and profit from volatility. Then, when fear reaches its peak, deploy capital into cheap, quality assets. Across the last century, that sequence has created outsized returns for those willing to act before panic becomes visible to the crowd. If this framework opened a new window for you, hit subscribe and follow along. Over the coming months, I will monitor the signals in real time, flag insider activity, track central bank gold flows, and show how volatility markets are evolving. I will also publish periodic, short tactical updates so you know exactly where we stand relative to the window that historically precedes major crashes. Remember, the 3 trades must be made before the event. When the storm is visible to everyone, the liquidation wave is already underway, and it is too late to preserve optionality. The choice is yours. Will you join the small subset who prepare, protect, and profit when panic arrives, or will you watch history repeat itself from the sidelines?